The only problem with fiat money is that it tends to create more money because governments can easily create more money by simply printing more money. The printing of the more money, the cost of which is almost zero, especially in the digital age. You could easily create money, but as a result, you also create with it inflation. Inflation, by the way, also it doesn't necessarily mean that goods are more expensive. It just means that you need more money to buy these goods. So in many ways, you could think about inflation as the erosion of purchasing power of a given dollar or a given shekel rather than the increase in price. So around 2008 and finally in 2009, a new currency came to being, and that is Bitcoin. Bitcoin changed the rules of the game and recreated what we understand as money, going back in some way to the gold standard. So what is this fiat currency that Bitcoin attempts to replace? Fiat currency is represented by central bank liabilities and deposits in commercial banks. It relies on a system of ledgers integrated into a banking system, which happens to be fragile at times. It's accepted for payment for tax. Banknotes and coins are legal tenders for all public and private debts. That is, you can always pay your debt, both to the government and to the private sector, using the fiat money. And it has a unique tax treatment. You don't have to pay, for example, capital gains tax on fiat money. So if we look at the banking system using the fiat money, it usually has a central bank. The central bank decides the supply of money. Its cash is liabilities to the central bank, but it also forms the assets of the commercial banks. The commercial banks get this money and they make money by lending out to me and you and businesses the cash that they have. So the business model of the commercial banks is to get money from the central bank and to resell it at a higher price, that is, at higher interest rates. If we look at the demand and supply of any commodity, including money, you probably already familiar with these graphs. When we have an increase in the supply, we usually have a decrease in the price. Money, however, is a special case in point. The supply of money is not dependent on the price of money. It's fixed by the government. The government decides what the supply of money, and by the way, the government increases the quantity of money on a regular basis, usually around 2 or 3%. The price of money is interest rates. The demand of money looks like the demand for any other product. It is a negatively sloped curve. And therefore, when you raise the supply of money, you should see interest rates go down. And with lower the supply of money, you see interest rates go up. It is through interest rates that the government controls the total output. Interest rates directly affect investment in the economy. What businesses are willing to invest depends on how much the price of money is. The lower the price of money, the more businesses are willing to take loans and invest it. So what is it that moves the supply and demand of money? The demand of money is affected by the income level, by the interest rates, by the price level, by inflation expectations, by the transactional needs, by speculative motives, and of course by technological factors. Probably the most important of these is the income level. We need more money when the economy grows. So as the economy grows, we need to produce more money to meet the demands so that the economy continues to grow and there is less friction in spending the money. Interest rates, also the higher the interest rates, the less the demand for money, because if the interest rates are high, the return on money is high, most people will keep their money in the bank and will have no need to use the money for purchasing products and services. Well, what about if prices are higher? If prices are higher, obviously the demand for money will also be higher because you need more money to buy things. And this is true if it's true or if it's expected. What about transactions? The more transactions we have in the economy, the same thing with income level, the more money we need to use, and therefore the higher the demand for money. And of course, speculative reasons, for example, we might expect the dollar to go up, so we might demand more dollars, or we might expect the shekel to go up, we will demand more shekels, or vice versa. And technological factors can, of course, impact the financial efficiency and therefore the demand of money, and that could go in either direction, up or down. So how does the central bank affect the price of money or interest rates? Well, one of the ways it does most directly is through the repo rate. The repo rate is the interest rate the central bank charges the commercial bank. So if the central bank lowers the repo rate, the banks, the commercial banks, can offer loans at lower interest rate and therefore decrease the interest rate for the consumers. The reserve ratio is the amount of cash that the bank needs to have on premise or in the bank. The higher the reserve ratio, the less money that the bank can lend out. And therefore, by changing the reserve ratio, through regulation, the central bank can affect the total supply of money and therefore the interest rates. And finally, the central bank can change the supply of money through open market operations, that is, buying and selling government bonds. If it buys bonds, it can increase the money supply, and if it sells bonds, it decreases the money supply. So let's talk a little bit about our legacy financial system. Our legacy financial system, built with a central bank and commercial banks, has this multi-client interface, data and processing systems, economic rents, a whole slew of stakeholders which make money off of the current system, for example, commercial banks. A lot of concentrated risks that we saw, for example, in 2008 financial crisis, where the collapse of one big bank can create a cascade of collapses throughout the banking system. The infrastructure, system costs, and counterparty risks are there. And of course, every so often, especially in developing countries, we have crises leading to instability, both social and economic. The current financial system is quite expensive. The legacy financial system costs, by some estimates, something like 7.5% of the total US GDP. And our payment system costs somewhere between 0.5 to 1 full percentage point of the total global GDP. So one can conclude from this that the current financial system of central banks and commercial banks is very, very expensive.